Hi students, welcome back. We finished set 1 of MCQs in MTP Management Accounting for December 25. Now we'll be doing set number 2. The answers for set number 2. The first question. The primary objective of management accountant is to maximize profits and minimize losses. Simple, it is C. No need to discuss much on this. Then, the purpose of management accountant is help managers or management to take decisions, because they will take decisions to run the organization. In the ABC system, which of the following is likely to be classified as batch level? See, design is not batch level, inspection is not batch level, because every item produced, and then production manager's work is not batch level. So machine setup is batch level. So it's a simple question. Similar question we answered in the previous set. Process of cost allocation under activity. This is very, very important. Under activity based costing processes, identify the activities, identify the cost of activities, then the cost driver, then allocate to the jobs. A very clear path is given in C. Identify activities, then cost of the activities, then cost driver, then cost allocated to the objects. So the option is C. Now, fifth question. Determine the sales in units. We have given desired profit 5, desired profit 5, fixed cost 15. So here the formula is fixed cost plus desired profit by contribution per unit. Fixed cost plus desired profit by contribution per unit is 20 minus 16, that is 4. So 20,000 by 4. 20,000 by 4, I think 5,000 units. So the answer is A. Now, if BP you should compute sales of 1 lakh, variable cost is 50,000. So the contribution is 50,000. And profit 20 means fixed cost is 30. Sales, variable cost, contribution, fixed cost, profit. So now we should know what is BEP. So BEP is, first of all, you compute PV ratio, contribution by sales into 100. PV ratio is 50%. 50% PV ratio, and BEP value equals to fixed cost by PV ratio. Fixed cost is 30,000. PV ratio 50%, hence it is 60,000. The answer is A. So check it out, 60,000 at variable cost 50%. So 30,000 is contribution, fixed cost 30,000. Answer is, profit is actually, so 60 you need. If you get 60, contribution equal to fixed cost, right? So contribution equal to fixed cost equals to BEP. That's very, very a simple question. Now, fixed cost includes all of the above. Simple. Property tax fixed, rent fixed, insurance premium fixed. So fixed cost includes all of the above. This is a very simple question. Next question. Guys, you need to think very quick in the exam. See here, P and Q, two divisions. P manufactures an item and transferred to Q. No external market, so all 6,000 units sent to Q. Variable cost is given, fixed cost is given. Because I'm only looking at P, because head of the management decided to transfer price should set to provide a profit of 30,000 to P. So let us see P. P wants a profit of 30. So P is fixed cost 120. Desired profit 30. And P's variable cost is 6,000 units into 100, 6 lakhs. So my total cost 6 lakhs plus 30, 1 lakh 20. My total cost 720 and my profit is 30 expected. So my sale should be 7 lakh 50. If I transfer, I should transfer at 7 lakh 50 divided by 6,000. So if I transfer at 125, what will happen? 6,000 into 125, my sale price, transfer price 750 minus variable cost 6 lakhs. I'll get a contribution of 150 minus fixed cost 120. I'll get a profit of 30. So 750. I recover my variable cost, I recover my fixed cost, I recover my profit at a sale of 750. So 125 is the answer for question number 7. Hope you understood. I'm doing it quickly because in the examination you must do fast. Should keep in your mind that my calculations must be quick. Here we are identifying transfer price of department P. So we should see what is the price which recovers my entire cost plus profit. So my profit 30, my fixed cost 120, my variable cost 60, total cost plus profit 750 divided by 6,125 should be my transfer price. Now, the advantage of standard cost includes all except, yes, standard cost helps in management by exception, standard cost helps in management planning, standard cost helps in simplifying the cost of inventories, but it is management must use static budget is a wrong thing. So it can't be. So D is the answer, which is exception for the advantages of standard cost. Now, which of the following equations can be used to calculate quantity variance? Quantity variance, even without looking at it, we'll say standard quantity minus actual quantity into standard price. It should be the answer. Standard quantity minus actual quantity standard price. If you divide this, it can be standard quantity into standard price minus actual quantity into actual price. Here quantity. So where it is? Where it is actual quantity. So actual quantity, standard quantity and standard price. I think quantity variance generally should be standard minus actual, but here it is actual and standard. Still we can go with C. C gives the variance because standard into standard, actual into actual. So the answer should be C, because C is price is common but the quantity varies. We should see the quantity variance. Quantity varies. So looking at the options, I prefer C is there. So because here price is constant, quantity must differ. So here actual minus standard. Very clear. Now, the process of budgeting helps in control of. Budgeting helps in control of all cost of production, liquidity, capital expenditure. Yes, all. So budgeting helps in control of cost of production, control of liquidity, control of capital expenditure, because capital budget, working capital budgets and production budget. So it helps in control of all. So very simple. Now, return on equity. We all know the formula. It is net profit margin into asset turnover ratio into what? Financial leverage or operating leverage. These two are common. Here we should see the complete formula which exactly we write in the examination if it is a sum, like practical question. The formula is here NP by sales into sales by total assets into, see here, NP by total assets already. This is net profit margin and this is asset turnover ratio, and we'll also total assets by, we do with total assets by equity. So this is financial leverage. So basically sales gets off, assets gets off. It is nothing but net profit by equity. So net profit margin into asset turnover ratio into financial leverage, where it is A. So the answer is A. Net profit by sales, net margin. Sales by turnover, sales by total assets turnover ratio, and then total assets by equity is financial leverage. So this is the main answer. The 12th is A. You're almost there. Responsibility accounting is basically used in cost control. Simple. No need to discuss. We are making cost centers, making everybody responsible for the cost and profit. Cost centers, profit centers. So basically, responsibility accounting is for is mainly for cost control. Moving on, a type of decision making environment. See, decision making environment has some certainty, some uncertainty, and some risk. If I say decision making environment can be classified into certainty, risk, and uncertainty. As per the definition itself, the answer is D. So no need to discuss much. Few decisions we can expect with certainty, few decisions we can expect uncertainty, and risk is inevitable in any decision making. So the environment is all of the above. Now, the minimum expected opportunity loss. Very, very important theoretical question it is. The minimum expected opportunity loss means basically we call it as EOL, the minimum regret. So it is always there. Minimum regret. So what is the minimum regret we want to lose? And also it should be equal to expected value of perfect information. So your EOL shall be equal to EVPI, and it is the minimum regret of not having the right information, smallest regret. So I can say it equals to EVPI and minimum regret. So the answer shall be D. The answer shall be D, which is both equal to EVPI and minimum regret. So the answer shall be D. So these are the important questions which are there in the MTPs. If you observe, can be done in 10 to 15 minutes maximum to score 30 marks. And I tried giving you detailed explanation. Guys, practice it and then listen carefully, do it on your own, and also try to find out the theory in your notes whether VD sir is saying this is correct or not. And NP and net profit margin, asset turnover ratio, and leverage, it is absolutely we did in the classroom as well. So go check and complete the answers. Thank you. All the best for your examinations. See you back with the balance department video for tomorrow's exam. Today night I'll be posting the balance 4 sums on department video. Thank you. See you again.